My guest today is Alex SPIROGLOU, and we're talking about technical analysis versus technical strategy, and what's the difference? Alex, so let's talk about that. How is technical analysis different from strategy?
Right. Let me, before answering that, saying that when someone begins to get themselves into trading, the first thing that they usually do is pick up a book or a seminar and start getting themselves familiar with chart patterns and enter the world of technical analysis. Although that is a step in the right direction, even for example going through a certification process like the CMT of the Market Technicians Association, they usually make a mistake of confusing technical analysis with technical strategies. And let me give you that by way of an analogy. Technical analysis is like learning the ingredients, what the flour, the butter, and the milk is. Technical trading and technical strategies is learning a recipe, is learning how to combine these issues, these tools that you have learned on its own. For example, what is the RSI? What is the oscillators? How do they work? What are the moving averages? On their own, they are not much use, but when they're put in context with each other, thus creating a recipe, then you can switch from technical analysis into technical trading.
All right, so I'm using that analogy a little bit further. I know a lot of traders try to combine too many ingredients into one recipe, so how should they start? Should you just use one, learn how that works, make some trades on it, and then try to combine to find confirmation, or what do you suggest?
Yeah, I know exactly what you're talking about. I have seen charts that they usually refer to as Christmas trees. They have so much flashing tools and wiggles and waggles of technical analysis. I mean, it's almost impossible to read through it. I think it's critically important, because there are literally hundreds of technical indicators out there, is to put them in the correct family, each one. Are they, say, addressing volatility? Are they addressing volume, sentiment? Because there is a lot of multicollinearity, statisticians call them. I mean, there are a lot of tools that pretty much sing the same song. So you have to make sure that you initially don't use, for example, the Williams percent R and the stochastic oscillator. Pretty much tell you the same thing. And then you have to combine these tools, 1, 2, or 3 at a time. That's the maximum. It's more than enough to do the job. Which one is, for example, to use it as a setup tool, something that will give you probabilistic bias for a market that is, like, for example, to go up or down, but it's not your actual trigger, and then use one for your actual, this is in where I get in. So the answer is you don't have to use many, 2 or 3 max.
Keep it simple.
Yeah, exactly.
Alex, thanks for your time.
Thank you very much.
You're watching the MoneyShow.com video network.